If you've been eyeing up some very appealing UK dividend stocks, then this video could save you a lot of headaches, because today I'm reviewing 10 of the most popular dividend paying companies in the UK and rating them on a scale of 1 to 10. But we won't just be focusing on dividend yield. That would be like dating someone purely on how they look. It may work well in the short term, but may not be sustainable long term before reviewing other qualities. I'll be rating them based on 6 factors: revenue growth, profitability and free cash flow, share price performance, valuation, risk, and of course, dividend yield and sustainability. With that, let's get into it. AstraZeneca, a global pharma giant, and over the past few years, revenues have grown steadily. Not explosive, but consistent high single-digit growth. Their earnings are being reinvested heavily into R&D, but they still generate billions in free cash flow, which covers the dividend comfortably. Speaking of which, the yield is modest around 2%, but crucially it's sustainable. The payout ratio sits near 60%, so they're not stretching themselves. Share price growth has been solid, reflecting investor confidence in the pipeline. The main risks, however, would be regulatory approvals, competition from generics, and large debt from acquisitions. Its price to earnings ratio also sits at 29, which may seem expensive, especially compared to peers, and that could limit its upside. So overall, AstraZeneca offers reliability and global exposure, but it's more of a growth plus modest income play than a high yield pick. And for that reason, I rate it 7 out of 10. HSBC, one of the biggest global banks and a huge player in Asia. Revenue has been volatile. Rising interest rates have boosted income, but cost and provisions for bad loans have kept profits lumpy. Free cash flow is healthy, but like all banks, it's very cyclical. The dividend yield is attractive, around 4.8%, and they've also been running buybacks, which support shareholder returns. Share price performance has been volatile, but it's recovered well since the pandemic, with a 5-year performance at a staggering 224%. But its main risk going forward is exposure to emerging markets, regulatory fines, and of course currency swings, having that global exposure. Overall, HSBC is a strong income pick with strong financials, but you have to be comfortable with the cyclical nature. I rate it 7 out of 10. Unilever is a classic defensive stock. They make everything from Dove soap to Hellmann's mayonnaise. Revenues have grown modestly, with price rises offsetting volume pressure in a tough inflation environment. Free cash flow remains strong, but it did dip in the first half of this year due to those cost pressures. Still, it's more than enough to cover dividends. The current dividend yield is around 3%, and payouts have been steady for decades, making it a favourite among income investors. Share price growth has been underwhelming recently, but that's typical of this type of business. The main risks to Unilever would be rising input costs, intense competition from private labels, and currency exposure given their global footprint. But Unilever is that boring, dependable stock that will probably still be around paying dividends in 20 years from now. And for that reason, I rate it 8 out of 10. Rolls-Royce is a turnaround story. After nearly collapsing during the pandemic, it staged a recovery under new management. Revenues are up thanks to rising demand in civil aerospace and defence contracts. Free cash flow has turned positive again, which is a big improvement in recent years. And they even restarted dividends in 2025 after a long pause, as well as announcing a buyback program. That's of course great news for shareholders, but the dividend is tiny, especially compared to others on this list, and nowhere near pre-pandemic levels. The main risks for Rolls-Royce is that they're tied to airline traffic, supply chain bottlenecks, and they carry high debt. But share price performance has been very strong, and it's recovered really well, with 1-year performance a massive 129%. Valuation now reflects a lot of optimism, but dividend reliability remains uncertain. A fascinating story and definitely one to watch, but not a reliable dividend payer just yet. And for that reason, I rate it 4 out of 10. Shell is a global energy giant, still dominated by oil and gas, but with investments in renewables. Revenue and profit have soared in high oil price years, generating huge free cash flow. In 2024 alone, they returned billions to shareholders. The dividend yield is about 4%, and they've been consistent since reinstating the payout post-2020. Dividend cover is decent, with cash flow comfortably backing it up. Share price performance has been steady, but of course it follows the oil cycle. The main risks to Shell would be regulatory pressure, climate transition, and the volatility of commodity markets. However, the demand for oil and gas isn't vanishing overnight, and Shell are diversifying into renewable energy. So overall, for income investors, although it can be cyclical, Shell remains a reliable income payer. And for that reason, I rate it 8 out of 10. BAE Systems is the UK's largest defence company, and it's seen strong demand, benefiting from rising global defence spending. Revenues and earnings are growing in high single digits, and free cash flow is targeted above £1 billion for 2025. The dividend yield is modest at around 1.7%, but it's very secure given the long-term contracts and government backing. That dividend yield could be seen as lower due to its share price performance, which has been excellent with a 1-year growth of around 57%. The main risks would be government budget changes, contract overruns, and political scrutiny of defence spending. With defence seen as essential, it's arguably one of the safest industrial income stocks in the UK. As an overall company, I would rate this 9 out of 10, but purely for a dividend stock, I reduce it slightly to 8 out of 10. Rio Tinto is a mining giant heavily exposed to iron ore, copper, and aluminium. In strong years, free cash flow has exceeded $6 billion, allowing them to pay huge dividends. But in weak years, those payouts shrink. The current dividend yield is sitting around 6%, but it will vary with earnings. Share price performance has been range-bound, and it tends to move with China's demand for steel and global industrial growth. The main risks to Rio Tinto would be ESG, environmental challenges, geopolitical issues, and dependence on volatile commodity cycles. So overall, Rio Tinto is your classic cyclical dividend stock. Great income when times are good, but risky when commodity markets turn. And for that reason, I rate it 6 out of 10. M&G is an asset manager and insurer spun out of Prudential a few years ago, and I actually used to work there. Revenues are steady, but they're tied to assets under management, so when markets fall, their earnings take a hit. Free cash flow is solid in normal markets, and they pay out a large chunk of it to shareholders. The dividend yield is sitting at a juicy 8%, which is very high, but coverage could be seen as thin. Share price performance is slightly volatile, but 5-year performance is currently sitting around 62%. And the main risks would be outflows, poor investment performance, and solvency rules. So overall, M&G works as a great income pick if you accept some volatility. I rate it 6 out of 10. Legal & General is another income favourite. They run pensions, annuities, and investment management. The first half of this year showed solid growth, with core earnings per share up 9%. The yield is enormous at around 9.02%, making it one of the highest in the FTSE 100. The risk, of course, is whether that dividend is sustainable. Their balance sheet is solid for now, but similar to M&G, a lot of their performance is going to be based on market conditions. Share price performance has been pretty flat, with 5-year performance sitting around 22%, and I think that reflects investor concerns. The risks to Legal & General would include interest rate movements, regulatory change, and longevity trends. Overall, Legal & General offers a great yield, but don't be blinded by that number. I rate it 6 out of 10. Taylor Wimpey is one of the UK's biggest house builders. Revenues rose in the first half of this year by around 9%, but profits dropped over 20% due to one-off charges, including cladding and fire safety costs. Despite that, they still paid a huge dividend, with the yield currently sitting around 9.6%. That may seem tempting, but payout coverage is weak, and it could be cut if housing weakens. Share price performance has been very, very poor, with 1-year performance at negative 41%, and this reflects the affordability issues in the housing market. The main risks would be high build cost, regulatory liabilities, and exposure to UK interest rates. Overall, Taylor Wimpey is high yield, but very fragile. And for that reason, I rate it 3 out of 10. So here are my overall rankings, based purely on being a dividend-paying stock. Which of these do you own, and which one should I do next? Thanks for watching. I'll catch you in the next one.